Well, welcome everyone to the May FX webinar. My name is Paul Robson. I'm head of FX strategy for Europe here at NatWest. We'll be following the normal format that we've gone through for the last few years. So I'm very happy to say that I have Piers Leslie of Fact, Not Fiction, to help me run through what's been happening to FX markets over recent months, and importantly, just try and have a look into the future to what may or may not happen. As normal, I'll be giving a fundamental view of the factors we think are important in driving FX markets. Piers will be running through a technical analysis of major currencies, concentrating as normal on the main currencies that are important to our clients here at NatWest. What I would like to do for my part is just to spend a little bit more time than normal thinking about the dollar. In recent months, we've heard from Brian, my colleague in America, who leads on trying to interpret what may or may not happen under a Trump presidency and how that might impact the dollar. And I'm just going to talk a little bit more in detail about that before thinking about where sterling fits in to that. Okay, so this first slide really just highlights that dollar weakness has been the number one theme in major currency markets this year. It's a relatively simple chart, but I think it's well worth just reminding people the extent to which the dollar has weakened during the past 3 months. So just looking at that table, all against the dollar during this year. So topping the table there at a 13.6% gain against the dollar is the Swedish krona. I don't think many Americans will be holidaying in Sweden this year, given the size of the move. There's been something very specific, I think, going on in Sweden, the Swedish krona, but that's a little bit beyond this call. But you can see that the dollar was the weakest currency, and some of these numbers are really quite noticeable. And I think for companies that have FX exposure, they are moving the dial, and therefore I wanted to spend a little bit more time on the dollar. You can see that sterling there, sort of mid-pack, maybe towards the lower end of performance. But remember, sterling had performed pretty well last year, so you'd already had quite a large recovery. At the bottom of the screen, you'll see the link to our weekly podcast, the Currency Exchange. If you want more details about the things I'm going to be talking about today, you can look out for that and subscribe, and we go through similar kinds of analysis each week in different currencies. But that's an extra resource that you can get here from NatWest. If I could just have the next slide, please. So this is just a graphical interpretation of really the chart, the table that I've just put up, that's showing dollar weakness has been the main primary theme. Just for the dollar, I do think that there's 2 important points actually. One is, I think this is going to be a dominant driver of global currency markets this year. The dollar is a key anchor for FX, and if the dollar is moving, there'll be a whole range of other currencies moving as well. And the second point, I think that you're going to hear a lot of people talk about whether the weakness in the dollar that we've seen is cyclical, that's just driven by the data, and the data move around and expectations change, particularly about monetary policy, and that's important, or whether it's actually structural. And if it is structural, it would mean that the data that are published every month are less important, and that you may well get multi-month moves in the dollar, and that's something we'll be looking at. But these two charts are pretty simple. The first chart is sterling dollar since 2024, and the second chart is the same for sterling euro. So a couple of points here to make. That sterling dollar cable is reaching the top end of its trading range. So multi-year highs are currently being tested. If we go a little bit higher, then really we're testing the highs that we've seen at the back of sort of 2020, so through the COVID period. We're still obviously a long way from the levels that we saw running into the euro area periphery crisis, and before that, the global financial crisis. Some people remember all the way back that sterling dollar was above 2. But it's clear that sterling dollar has moved a long way. But it's interesting, the second chart there on the right-hand side, which is sterling euro, which actually has weakened. So that just highlights that it has been a dollar move. People just looking at sterling dollar in isolation might make the wrong inference that it's a sterling move rather than a dollar. Sterling, for what it's worth, I think there was a little bit of market dislocation through the Easter period. Maybe markets were a little bit liquid. You had this move down, and sterling sort of regaining its poise a little bit, and that's something that we think is sort of justified by the economic data and the fundamentals here in the UK. So these two charts are just trying to get to the heart of why the dollar has been so weak. So the left-hand chart there, one of my favorite charts, I think I had it on the previous webinar back in March. It's rolling GDP expectations from market participants for the UK, US, and for the euro area, and they move over time as the data come in and people adjust their expectations. And you can see that expectations for the dollar have really been in free fall. They really have collapsed. They're still higher than here in Europe, but for FX markets, quite often it's a change in expectations rather than the level. And it's clear that the sort of US exceptionalism, high yields and strong growth of recent years does seem to be being challenged. And the right-hand chart is just trying to get an idea of what's been driving that. And I think most people on the call understand that US foreign policy, domestic policy, and international trade policy is shifting. One of the key parts of that is tariffs. And this is a chart that is reprinted from the FT. The link is the source and the link on this chart. And actually, the FT published a very nice set of charts looking at Trump over the first 100 days. But you can see that in terms of tariffs, this is a dramatic change in the international trade relationship between the US and the rest of the world. And it feels like this is having a knock-on impact onto growth expectations. And there's also other expectations about downsizing the federal government. So for the dollar, and again, thinking about whether it's a cyclical move or a structural move, I think the first place to start is just the extent to which overseas investors hold US assets. And the numbers are very large indeed. Here at NatWest, we're looking at it in three slightly different ways. We're looking at holdings of dollars in global FX reserves. We're looking at the degree of retained earnings of corporates in the US. And we're also looking at just general asset allocation of international investors. So whether professionals, if it's hedge funds, it could be the general public in their ISAs and their pension schemes. And as I say, the numbers are really quite large. If we just think about global FX reserves, they are $12 trillion. And this right-hand chart shows the share of those reserves that are held in dollars. and it's about 50%, 55%, give or take a little bit of a change. It moves around a little bit. It's been declining on a multi-year basis. If we were to draw this chart back in the 1900s, sterling would probably be 100% of global FX reserves, and then some with dollars, but gold. But it's very much the dollar. And it's a very simple point, but it's a very important point, that small changes in the allocation of reserves into dollars, if that changes, that percentage changes just by a small amount, potential flows are very large. And this is what we saw at the beginning of the noughties. That's when, as I mentioned earlier, sterling dollar was up at 2 and euro dollar was up at 1.50. And this is potentially important for sterling, because one of the key things we've been highlighting is fiscal stability risks. But it's been really interesting to see that overseas demand for government securities has actually been rising at a time when sterling's share of global FX reserves has also been rising. And obviously, if there's greater demand for gilts, then the price falls, the price rises and the yield falls, and then that obviously makes fiscal policy easier. In terms of the other drivers, retained earnings, corporates have, on the balance of payments data, have left lots and lots of money, by the looks of it, in US dollars over recent years. And if they decide to take that home or start to hedge it, that would be important. And the final point about equities, it does feel that the world owns an awful lot of US equities. And because of risk correlations, they've done that unhedged. So if they decide that they want to reduce the number of US assets in their portfolios, then that would obviously be important. So for our side, we do think that the balance of risks are that the fall in the dollar we've had is more structural than cyclical, although nothing is certain, and we'll be watching the data very carefully to see how the dollar trades. So for sterling, it's really just the same outlook. I think actually sterling has been sidelined. I think it's all been a dollar world. That's why I chose to talk about the dollar rather than sterling directly. So I've just got a few charts for sterling, and I'll go through those relatively quickly. If anyone wants any more details, then please check out those currency exchange podcasts where we update our thoughts on sterling on a regular basis. So this chart just shows the main drivers of sterling: relative interest rate policy, fiscal policy, stagflation risk, fiscal policy. And number 5, which is a new driver, is that asset allocation away from the dollar. The chart at the top right just shows how sterling dollar has been running ahead of interest rate expectations, which has been a key anchor in the past. I think that also highlights that there's a new driver of global currency markets, potentially those asset allocation things. For the Bank of England, we still think the Bank of England is going to be relatively cautious in cutting rates, and that should be helpful, maybe not against the dollar, but against other currencies. Fiscal policy remains the clear risk, but it's very much periods of increased stress in currency markets. So fiscal policy cannot matter for a long period of time and then suddenly does, but something around the autumn statement coming, or the budget coming in late October, early November, might be important. So these two charts really just shows that consumers remain relatively cautious. Savings have risen. Yes, they've had rises in their cash incomes, but inflation has remained relatively sticky, and spending remains relatively weak. Although we have had bright spots in terms of 3 back-to-back increases in cash and volumes, sales growth on the high street, which is obviously a positive. But with the labour market softening, we think that consumer demand won't be the key driver of growth. And this is just another chart that we've used a lot over the past. It's just showing inflation. It does feel like the little blip in inflation that we were expecting won't be as significant as previously expected. you've had exchange rate strength, you've had lower energy prices, and you've had softer economic growth. So it feels like the Bank of England can be a little bit more confident that inflation's coming down, and therefore lower interest rates potentially a little bit further than we previously expected. And that's actually shown on the next set of slides. So here again, I've taken what NatWest economists think and the Bank of England will doing relative to the market. And I've also shown it, so I've shown it from the Bank of England, I've shown it from the Fed, and you can see that the Bank of England is expected to continue to cut rates. Markets expect them to cut them a little bit quicker than us, but there's not a lot in it. The US Fed policy, I think that's going to be an area of focus, to what extent the Fed have to keep rates on hold for much longer than markets expect because of their inflation credibility. They've got tariffs. And then just the final chart. These are the published set of economic forecasts. Just one point to say here. Our forecast for sterling euro, you can see from the bottom right hand chart, in line with the market consensus. For sterling dollar, we're just a little bit above consensus, and that's that worry about dollar weakness being a little bit more structural and cyclical, and therefore extends. So that, and then just the final chart, please. Potentially the most important. This is something that Piers has always reminded me, and this is the disclaimer that goes with my part of today's presentation. With that, I'll pass the webinar over to Piers for his rundown of what the technicals are showing in terms of the currency outlook.
Thanks, Paul. Very interesting stuff there. Right, so if we go to my first slide, I'm going to remind everyone, the beginning of the year of the snake, volatility. I don't think that volatility has gone. It's a year. So it's a year of the wood snake, and I'm just going to say I think that volatility continues throughout the year. So we go to the first chart. This is the dollar index. So you have these two black upward facing lines, an upward channel it's called. So since 2008, it's been going nicely from the bottom to the top, to the bottom to the top of this channel. Now, we've just come down where that red arrow is. This quarter, we've seen it fall even further, but bounce off that trend line. If you get off the base of that channel. So if you get my weekly charts, I've sort of gone on about this. So we are seeing a bit of a bounce in the dollar. It's also the 38.2% area of the whole move up. And that's why we're seeing this sort of bounce off there. But it is still very negative. And what's important now is how strong is this bounce? And it needs to get above 101, 102 to take away the downside risk and further dollar weakness. But we do have a sort of zone underneath, sort of this 91, 96 area, which if the dollar does move into that area, it should again find some longer term support, but it will be a concern then for the longer term outlook for the dollar if it starts to take out that base of the channel and the 38.2%. Where does the dollar have to go to get its strength feeling back? It needs to get above 106, 107 basically. So at the moment, we're below the 101, 102. So I look at that, the initial resistance and the initial support around about the 96.50, 97 area. And we need to see how does this rally play out. And that's the key bit. And I'll keep you posted on those weekly charts that I send out. So the next slide is euro dollar. And I just like this because it sort of reminds people how to look back and see where it is. So we have a trend line since 2000 and it broke the other year and we saw it fall down. And from there, we got retracements. And the 23.6% retracement at 110.70 held euro dollar. And it started to go down. But this year it's gone up, taking out the 23.6% retracement. But look what's capping it. It's the old trend line, the rule of polarity. Old support becomes resistance. So that's around about 114.80. So you need to see euro dollar start to hold above that area if you're looking for the next retracement, which is up at 120.20. But at the moment, it's being held by that sort of 115 area, we'll say, because it's 114.80. So it's a sort of 5 cent range to watch on euro dollar, 110 up to 115, and see where it breaks out of those two for your next sort of 5-cent move. On the next slide, let's go back to one which I know is more interesting to UK corporates, sterling dollar. And I'm going to put this yearly chart on. Again, the rule of polarity. We're just talking on euro dollar. Support and resistance switch. So since 1980, we have these retracement lines. And you can see in all those pink circles going across, the first four, every time sterling dollar got down to that retracement, the 23.6% retracement area, 137.85, the market bought it long term and it rallied for a few years. Always for at least a good few years rally off that area. That changed in 2016. We saw it go down through there. Then it's been held. So it switched to resistance. So since Brexit, every year since Brexit, it's gone up to that area and failed, or attempted to get near it. If it hasn't reached it, it hasn't reached it. But if it has reached it, it's stalled it. So I also see an area around about 139.60. So 137.85 is basically 138, 139.60. So the 139, 138 area will be long-term resistance if price gets up there. You should see some initial sort of selling off there. But if it breaks through there, then especially if it breaks through there and holds it into the year end, which is a long way away at this stage, it's a long way up to the next retracement. That's all I'd say here. So watch that 137, 185, 139.60, key area of resistance on the long-term picture. On the next slide, I go to the monthly one. And this monthly one, I'm trying to look at the support areas. On the last slide, I tried to give you where's the long-term resistance. What we're trying to see is since basically September, it says July underneath, but it's between July and October. It's the Liz Truss crash. And since then, cable's been in an uptrend. It's had higher highs and higher lows. Now, if we look at the high there, we see is 134.36 last year. Price came down. Where did it stop? It stopped at the 38.2%, the green line. 2 months, you held that. Then that's the impulsive trend is still intact. So it's gone to the old highs, 134.36. But what I'm trying to point out here is where are the areas of support? If we don't see cable higher than 134.36, they remain 127 will remain a key area. You can see that the market's reacted there for 3 months. Went up there, stalled 1 month, broke through it the next month, came back to test it last month, and then rallied off it. So 127 area, but the key area is the 38.2%. If we get a new high, the 38.2% will move up with that new high. But at the moment, it's 122.5. It worked very well the end of last year, the beginning of this year. So just keep an eye on that. We're thinking on these webinars, we try and keep longer term picture. Shorter term, we tend to do on the weekly and daily charts. So the next slide, thanks very much, is the monthly candle again. But what I've done here is I've added a downtrend line because we broke the downtrend line back in 2024 and price rallied. Then it came back down to the trend line and also the top of that yellow bit, which is called the Ichimoku cloud. So that all came in where that 122 area is. So there's a lot of support there. So that's going to be very key going forward if you're thinking long-term sterling dollar. The other thing I have on here are Bollinger Bands, which is the 2 red lines with the sort of pink line in the middle. The pink line is the 20-period moving average. And you can see that has sort of come in at the moment at 127.70. And the reason I like that on there as well is because if you remember the last slides we were looking at, it had 127 as an area, as a retracement to watch. So the 127 area should be good support. We've seen it bounce off there last month. Now, at the moment on the monthly chart, I sort of see resistance in the 135.80, 136.45 area. And I've been putting that on my daily charts. If you start to get there, I think you'll see some short-term sort of stagnation in sterling dollar. That's where you could see people start to decide the move's overdone, I'll take some profit. So this is the weekly chart. So on the weekly chart, what I'd like to show here, in January this year, price broke the downtrend. Then we saw price go back down and test the downtrend, and it's gone higher since then. So that's worth remembering. We've broken the downtrend. So if you're thinking, oh, last year sterling dollar was going down, you know, the end of what you see here is the end of last year. And that was really sort of fulfilling that 8-year cycle where cable closes lower than it starts. But we've broken that downtrend. So what else can we look for on the weekly chart? Let's have a look. So we go to the next slide. Again, we're just going to look at the retracements. They seem to just work so well. So these are the retracements of that downtrend we just looked at. I took the downtrend line off, not to have too many lines all over the place. But look how it's worked going back up. Every area, every retracement is where it's paused on the move up. So it's gone to the 23.6, had a few weeks, then gone to the 38.2% in a week, paused there for 3 weeks. Then in a week went up to the 61.8%, paused there sort of 4 or 5 weeks, then went to the 76.4%, paused there. Then it went up and it's had 2 weeks stopping at that 134.36. So that's going to be quite an important area. If you see a weekly close above 134.36, it means we're going to look for a move pretty up towards that 135.80, 136.5 area. But at the moment, that is resistance, or 134.36. Then on the next slide, where is the support on this last rally? So instead of looking at the monthly one, the overall bigger picture, let's look at the shorter term. If you're more cautious and want to be quicker in on moves, let's just look at the retracements of the move up. So we know the low was 120.99 area this year, and we know the high was around about 134.24. I take the first one as opposed to the second week where it went higher, because the first week was a positive week, so the uptrend is intact. The next week was a negative week, so anyone who bought that week was sort of not very happy by the end of the week. So I prefer to do it off that. So that gives us 131 as a short-term support area and 129.18. So if you want to be quicker in on moves and don't want to wait for the larger picture to confirm, you can look at sort of the 129 area. 129, 131, that 2-cent area. If you get into that, something's not so great for cable. If you get below 129, this move up of this year is starting to struggle. It's lost its impulsive strength. So the next slide is sterling euro. And I've sort of changed this. I've actually put in I've stripped out everything apart from the Fibonacci retracements. So this year I've been saying watch 121.47 as resistance because it's the 38.2%. Every time since Brexit, it's got a 38.2%. It's fallen. No change this year. To the last quarter and the quarter before, 121.47 kept the market. It realized it wasn't going any higher, so it went lower. It's gone lower down to the sort of 116. It hasn't broken the 23.6%. So on the very big quarterly picture, you're still waiting sort of for a breakout of 116, 121.5. And it's just been sideways in that. But we have had the break of the trend line back in Jan 24. So things just a little bit more positive. So if we go to the next slide, I put on the Bollinger Bands and I put on the Ichimoku Cloud. This is the slide we normally do. So you can see it's actually the Ichimoku Cloud comes in bang in line with the 38.2. And what's capped it this quarter is the Ichimoku Cloud, just below the 38.2. So we could look at 118 from that Ichimoku Cloud to 121.5. When price gets up there, that's where it's going to have its battle. 115, 116 is your support. If you start to go below that 115 area, sterling's lost its shine against the euro. And the last slide I'm going to do is the sterling euro weekly, because this is the one I send out on my weekly charts. If you get the weekly charts, I pointed out that since 2023, we'd had a great trend line in sterling euro. Every time it hit that trend line, the market just rallied. So you had higher highs, higher lows, perfect uptrend. But then this year, what I pointed out was the rally at the start of this year in sterling euro only got to 121.37. Whereas we know last year it was getting up to that 121.47 area. It was getting a bit higher. So you had a lower low, and that's a lower high, and that's a worrying uptrend. So price went down, it did a small rally up, and it failed again. Then it broke the trend line. Price fell, and I haven't got it on here, but it actually fell to the 61.8% retracement of that whole move up. But what's happened since then? Price is rallying back up, but it's got the cloud. So price is below the cloud, it's going into the cloud now, and it's got the trend line. Those two should act as resistance. So to get positive against sterling euro on the weekly timescale and think, yes, we're going to attack that 121.5 area, you need to break through the 119.75 area. That's the 76.4%. Then it will have taken out the trend line, taken out the retracements, and that was just a false break lower. The market's now back in its uptrend. But at the moment, I sort of feel that 118.70, 119.70, that 1 cent should be tough for it. And we could see price come back down. It hasn't broken completely to the downside because the lagging line, where I put that red circle, the lagging line was held by the base of the Ichimoku cloud. And to get confirmation of a long-term break on the Ichimoku cloud, to break the weekly, you need the lagging line below the cloud as well. Then it will turn much more negative. But I hope that's been some use. The next slide, as Paul says, I love this slide. It disclaims everything we've just said. I said it's just our thoughts and views. And I hope you've enjoyed that run through the markets.
I think that's all that we've got time for this month's webinar, where we looked at the outlook for the dollar in terms of whether its weakness has been structural or cyclical. Piers has done his normal excellent job of running through the technical charts about what might hold in the future. And I'd just like to say thank you again for joining, and please join us at the beginning of June, when again, I think there'll be an expectation we'll be concentrating once again on the dollar, but maybe more on the US outlook and what to expect as various trade deals in the US potentially get signed. Thank you very much.